Hi there, welcome to Kneppy Invest. There is this perception out there, and have heard this a lot from retail investors and experts, financial analysis, that as soon as the Fed decides to stop raising interest rates or even start dropping interest rates, that will be really bullish for the stock market. In fact, some people suggest that this would herald in a new significant long-term bull market. And I can understand that because in the past, say 18 months or so, since the Fed started raising interest rates, I don't think it's been that long, maybe only 12 months. But ever since they started raising interest rates, we have seen the stock market struggle. So that perception that there is a positive or negative relationship between the interest rates and the stock market is based off very recent history. So I understand why people are thinking or waiting for this interest rate pivot from the Fed. But today I was listening to a podcast, and I'm always about alternative views. And this person had an alternative view. And this person actually said that history doesn't bear out this negative relationship between interest rates and the stock market. In fact, this person said there has always been a positive relationship between interest rates and the stock market. So when interest rates are rising, the stock market tends to rise. And when interest rates fall, the stock market usually falls. And the reasoning behind that is that when interest rates are rising, the economy is going gangbusters. So the Fed wants to start sort of taking out the steam of the economy. So they raise interest rates. And what tends to happen is they keep on raising interest rates too long, and that's when the economy starts to sputter and then moves into recession. And it always seems like the Fed raises its rates too long and then drops interest rates too much. So we get these boom bust cycles in the economy. So it's really interesting to hear this counter argument to this perception out there right now that as soon as the Fed pivots into a interest rate falling scenario, that's going to be really good for the stock market. So in today's video, I'm going to explore this very topic by looking at the past 70 years. And not only have I heard this argument from retail investors, Australian financial analysis, also Jim Cramer got into the act as well the other week when he said, when the Fed gets out of the way, you have a real window and you've got to jump through it. When a recession comes, the Fed has the good sense to stop raising rates, and that pause means you've got to buy stocks. So Jim Cramer obviously believes that there is a negative relationship between interest rates and the stock market. And we've seen that relationship play out over the past 12 months or so. And that means as soon as the Fed stops raising interest rates, you have to go all in. Hence, the motivation of me doing today's video. So what I've done is I've gone back through the last 70 years. And in this particular slide, we're looking at 10-year period. So this is from 1954 to 1964. And I have three features on this particular chart, actually four if you include the red star. But I've overlaid the S&P 500, which is a candlestick. I've overlaid the federal funds from Fed, or the interest rates. That's the black line. And the shaded green area is a recession in the United States. So let's have a look at this period between 1954 and 1964. And the red star is the interest rate pivot. So we've gone from a raising or rising interest rate environment to a falling interest rate environment. In fact, it happened twice in this 10-year period. Now, there were two cycles and or recessions. We also saw the Kennedy slide of 1962, sometimes also referred to as a flash crash of 1962, when the stock market fell 28.8%, but interest rates didn't change. So there was no raising or falling interest rates, and there was no recession during that period. Now, I'm not that big of a history buff to know exactly what happened during 1962, though I do know that the market did stabilize after the Cuban Missile Crisis. So perhaps the Cuban Missile Crisis was a reason we saw a dramatic drop in the stock market in that particular year. But if you look at the two non-recession periods, or just before we move into recession, there is a positive correlation between interest rates and the S&P. So interest rates were rising and the S&P was rising along with it until late in the cycle when the market started to struggle. Yet interest rates kept on rising. So this happened in both 1957 and 1960, leading into the recession. So you could say the market was forward looking. And the interest rate pivot, when interest rates stopped rising, they started to fall, happened at the start of recession in both occasions after the markets were struggling. So the market bottom in middle of recession, that's very important as well. So again, the market is forward looking. So the market bottom didn't happen at the end of the recession or just after the end of the recession. It happened in the first half of the recession, and interest rates low occurred at the end or just after the recession. You can see in 1958, interest rates hit their bottom right at the end of the recession and started rising again. And the same thing happened in 1961. So again, the stock market is forward looking. Now, there were no changes in interest rate policy during 1962. So again, I'm not sure what happened during that Kennedy slide of 1962. So that is one occasion we're going to skip. The other thing to note here is during the 1957 recession, the stock market or the S&P only dropped 20.7%, but there was no significant drop in the 1960 recession. In fact, there was just a small drop, but nothing significant, even though interest rates dropped from about 4% all the way down to a low of about 1.2%. Now let's have a look at the period between 1963, 64, and 1973. Now, between 1963 and 1966, interest rates and the S&P both were going up together. Then we had the baby bear of 1966. That's when the stock market dropped 23%. But you'll notice there was no recession during that period, and interest rates were rising during the baby bear of 1966. In fact, when there was a pivot in 1966, that was or coincided with the bottom of the market. And then the market started to rise as interest rates fell for a very short period of time. But again, between 1967 and 1969, there was a positive relationship between interest rates and S&P 500 until 1969 and into the recession of 1970. And you'll notice that, again, just like the 1950s, the interest rate pivot happened just before the recession and just after we started to see the market struggling. So again, the market was forward looking. The market started to fall well before the recession and well before the interest rate pivot. But the market kept on falling during the recession and hit the bottom halfway into recession in 1970. But interest rates kept on dropping during the recession and hit the bottom after the end of the recession in 1970. So again, the market is forward looking. And then during 1971 and 1973, interest rates and the S&P were rising together. They coincided. So again, there was a positive relationship between interest rates and the stock market during that small period of time. Now let's have a look at the next 10-year period between 1973 and 1983. And I was born during this 10-year block. Won't say exactly when I was born. Now, this period of time is noted as a period of high inflation and high interest rates, but those high interest rates and inflation were not sustained during this period. There were times during this 10-year block where interest rates and inflation were quite relatively low. So rates rose to 13% in 1974 and then fell to 4.5% in 1966 and 1977 before rising again to combat inflation. In fact, they rose to 19% in 1981. Now, the pivot in the middle of the prolonged 1974 recession is quite interesting. So in the past or the previous 20 years, we saw the pivot at the start of recession. This pivot in 1974 happened in the middle of the recession. There was a sort of a small pivot just before the recession, and then interest rates continued to rise in the first half of the recession before they dramatically fell from about 12% down to 5%. So again, the market was struggling before the recession and the pivot. So again, the market was forward looking. Now the market went sideways as interest rates started to rise from 1977 to 1980. In fact, the interest rates rose appreciably in that period from about 4.5% to 17.5%, again, to combat inflation. And during the 1980s, particularly the early 1980s, interest rates were, excuse me, interest rates were quite volatile. You can see interest rates going up and down quite violently during 1980, 81 into 1982. And there was a negative relationship between markets and rates in 1983. You can see the stock market or the S&P going on a rip-roaring rise while interest rates remained fairly low or even not started to fall, but continued to fall during that period. So this is the first time we saw a significant negative relationship between the interest rates and the stock market. That was in 1983. Now to the period between 1984 and 1994, and this was an absolutely beautiful bull market. The S&P went from the bottom left to the top right. This is the sort of chart you want to be owning or seeing if you do own a company. Now, even though this is a beautiful looking bull market over this 10-year period, there were two significant drawdowns in the S&P during this period. Of course, the first one was the 1987 crash, where the S&P fell 35% in a fairly short period of time. And you also had a recession in 1990 when the S&P fell about 20%. Now, during this period of time, if you look at the start of the period, 1983, and the end of the period, 1993, interest rates fell, coinciding with the rising or the bull market. So interest rates fell from about 11% to 3% in 1993, but there was a period of time between 1986 and 1989 where rates were rising. In fact, rates rose from about 6% to almost 10% during that 3-year period. And during that 3-year period, the stock market or the S&P continued to climb apart from that 1987 correction. But in that 1987, there was no interest rates drops, so there was no pivot, and there was also no recession. Now, you also notice a pivot, interest rate pivot in 1984, and as soon as they pivoted in 1984, or just before they pivoted, the stock market was struggling, and then they pivoted, and as soon as they pivoted, the S&P went on a massive run, or started their massive run. And then leading into the 1990 recession, this is something a little bit different from what we've seen in the preceding decades. We had the interest rate pivot well before the recession and well before the top of the stock market. In fact, in this occasion, the stock market was not that forward-looking. In fact, the top of the stock market before the recession of 1990 happened right at the start of the recession. Then we had that 20% drop in the S&P, and the bottom of the stock market was still in the first half of the recession. And then the stock market went on a massive run. And you'll notice that the top of the interest rate cycle happened in 1989. Interest rates were around about 10%. They started dropping before the recession, dropped during the recession, and then kept on dropping after the end of the recession. So a definite negative relationship between the stock market and interest rates from the end of the recession in 1991. Now we move on to the period between 1993 and 2004, and we're starting to get into periods where I'm a little bit more aware of what's happening and why it's happening. So there was a really good bull market between 1995 and 2000. Now before that, you'll notice interest rates were rising in 1994. In fact, solely in 1994, interest rates rose from 3% to 6%. But after 1995, interest rates went sideways, and that coincided with a great bull market for the S&P. The S&P went from about 440 all the way to a top of 1,520. So there was a fourfold increase in the S&P in about a 4-year period. Now, the interest rates went sideways during that period, but they started to increase in 1999, just before we saw the tech bubble burst, and there was a pivot in 2000, and that pivot in 2000 coincided with the stock market high, and the pivot and the stock market high happened just before the recession in 2001. In fact, the stock market and the interest rates started to drop before we went into a recession, and during the recession, both the stock market and interest rates continued to drop. And in fact, in this one instance, we saw the stock market continue to fall after the recession. In fact, the stock market continued to fall all the way into 2003. You also notice interest rates continued to drop after a recession ended as well. In fact, they dropped from 6.6% high before the recession in 2000 all the way down to a low of 1% in 2003 and 2004. Now let's have a look at the period between 2004, 3 and 2014, and a couple of really interesting things here. So the interest rates rose with the market between 2004 and 2007. So there was a positive relationship between interest rates and the stock market in that 3-year period. In fact, interest rates rose from 1% to 5.2%, while the S&P and the Dow Jones and the Nasdaq went on a bit of a roar as well. And then we got to 2007 and we had the pivot, interest rate pivot, just before the recession, and just around the time we saw the stock market reach its peak. And the stock market reached its peak just before the GFC in 2007, and then interest rates fell off a cliff, just like the stock market fell off a cliff as well. So there, again, there was a positive relationship between interest rates and the stock market during the GFC. Both were falling. In fact, interest rates fell from 5.2% back down to about 0.2%. And the bottom of the stock market, well, the bottom of the S&P happened in March 2009. The bottom of the Nasdaq actually happened quite a few months before that. If I remember correctly, it's like October, November in 2008, which would have been the middle of the GFC. And then as soon as the stock market hit its bottom, the S&P 500, the Nasdaq, Dow Jones went on a great run. And look at the relationship between the stock market or the S&P 500 and interest rates from the end of the GFC. So interest rates didn't start rising at all. They were just going sideways. So there was really no relationship between interest rates and the stock market at this point in time. You can't say it's negative or positive because interest rates were just going sideways. Now we're looking at the last 10 years, 2013 to 2023. And just like the last few decades, this is a nice bull-looking chart. The S&P 500 going from the bottom left to the top right. We have seen periods of weakness during this 10-year block, and right now we are in a period of weakness. But that's okay. We have seen this happen in the past. We also saw a period of weakness during the COVID-19 financial panic. So a few things to take into account here, not take into account, but notice here. First of all, that flat or lack of interest rate rising came to an end in 2016. And then the Fed started to raise interest rates during that year. In fact, they raised interest rates from 2016 into the end of 2018, start of 2019. In fact, interest rates rose from about 0.2% to 2.4%. And if you remember, the last few months of 2018 were quite negative for the stock market. And the main reason it was quite negative for the stock market was because of the market fearing this rising interest rate environment. So even though the market was rising alongside interest rates rising, so again, a positive relationship between interest rates and the stock market, that relationship came to an end in the last half of 2018. And then there was sort of a pivot from the Fed in 2019, start of 2019. You can see the interest rates went sideways and then started to drop. And the market absolutely loved that as we head into the COVID-19 financial panic, which I'm going to ignore right now because then interest rates fell all the way down to almost 0%. And then interest rates went sideways. The Fed went, no, we're not going to raise interest rates. And the market absolutely loved that. The market went on a massive tear during the last half of 2020 into 2021. But then we started to see interest rates rising. And this is when we have seen a negative relationship between interest rates and the stock market. As interest rates rose, the stock market started to struggle and fall. And that's why we perceive there is a negative relationship between interest rates and the stock market because of what's happened in the past 12 months. But history has shown us there is not always necessarily a negative relationship between the two. And quite often, we do see a positive relationship between interest rates and the stock market. In fact, just before we move into a recession, typically we see interest rates dropping and the stock market dropping at exactly the same time. It seems like there has been a lot of research done on this topic between the correlation or the relationship between interest rates and the stock market. So I'll just show you a few of the interesting things I have found. This is from Real Investment Advice, and their conclusion came out when they looked at the relationship between the two. From the start of 1900, there was no correlation or relationship between 1900 and the middle of 1990s, but from the middle of 1990s, there has been a relationship between the two. And during that period where they have found a relationship is a time where we saw interest rates dropping while the stock market went on a massive tear. And this is from Elliott Wave International, www.elliottwave.com. And they just went back through the last 60 years or so and went back to see when the Fed did that pivot from raising interest rates to dropping interest rates. And their conclusion was the majority of the decline in the bear markets occurred after the Fed's pivot. So we saw drawdowns of 36%, 48%, 27%, 51%, 58%, and 35% after the Fed pivoted. So this is sort of the bear case that you should watch out, because when the Fed pivots, more than likely you're going to see a massive drop in the stock market. Now, counter to elliottwave.com, wherever it is, who's suggesting that if the Fed does pivot in the interest rates, you have to be very wary because usually you see a massive drawdown in the markets. This little bit of research from LPL, dated 17th of November 2022, is really interesting. So they looked at the relationship of the S&P 500, Russell 1000 growth, Russell 1000 value, and looked at the performance of those three indices in relation to the pivot. So we have a pre-pivot performance and a post-pivot performance. And pre-pivot performance of these three indices left a lot to be desired. In fact, most of these indices were in the falling end of the cycle. But after the pivot, we start to see these three indices starting to climb. In fact, 1 year after the pivot, all these three indices are up over 10%. For the Russell 1000 growth, up 17.6%, S&P 500 12.9%, and the Russell 1000 value up 15.2%. And they mentioned in this bit of research, growth outperformance has historically become more pronounced around 6 months after a peak federal funds rate. And this is what we did see in a lot of the things we looked at, that when the Fed did pivot, the stock market sometimes might drop. And then, because the Fed pivoted typically at the start of a recession, but the stock market low occurred usually in the first half of the recession and then started to rise. So I do see some validity in this argument that when you do see the pivot, the next 12 months, particularly the last 6 months of that 12-month period, should be really good for the stock market. That's all I have for this video, looking at whether this much awaited, much anticipated interest rate pivot from the Fed will herald in a new bull market. And history has showed us that the interest rate pivot is quite important because usually it occurs just before the recession. And if we do go into a recession, and it remains to be seen if we do go into a recession, who knows, maybe we won't. But if we do go into a recession, there might still be a little bit more weakness in the stock market because typically the bottom of the stock market happens in the first half of the recession, and then we go into the bull market. Whether this happens again this year or maybe next year remains to be seen because, again, history doesn't repeat, but it often does rhyme. Now, if you have any questions about this topic I've raised today, I'd love to hear from you. So leave your thoughts in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.